episode 45 of Top of Mind with Consilio Wealth. And on today's episode, we are going to talk about the National Association of Realtors has settled. This was top of news here in the last couple of weeks. And I guess we would just share our thoughts on what we think it could do to home prices or lack thereof. And then we thought we'd dive into data. We have some data that top companies in the market don't always remain top companies. So we thought we'd break that down for our listeners. Quick slide over to GDP growth, which has remained strong but seems to be slowing a little bit. Everybody seems to be mentioning AI on their earnings calls, and that's making their stock prices go up. We've got some analysis on that too. If you say AI on your earning call, or if you don't, and what does that mean for your stock price? I think you'll find that interesting. And finally, industry analysts at this point forward, this came out on March 21st, yesterday, as the date of this recording. Industry analysts project a 7% increase in the S&P over the next 12 months. Our question is, how often are they right and how often are they wrong? Today is Friday, March 22nd. It is 3:12 in the afternoon. We're recording a little bit later than we normally are. I had to shift this to the late afternoon. But nonetheless, we are here, live and in color, and ready to rock and roll.
Ready,
set, go. How the National Association of Realtors has settled. This was kind of a big deal. It was an ongoing lawsuit. So there was some money that was paid back to I think it was a couple 100,000 people that ultimately got together and sued. So there was like a settlement that happened, money was paid back, and then the big thing is there's a lot of regulation now that is changing the kind of standard 6% commission that is paid fully by the seller of a home. So as you've kind of dove into this in the media, what's your take? What do you think this ultimately does and doesn't do over time?
Yeah, I think to start off, it's going to be speculation because we don't know what the upper limits are, if there are going to be any. If we completely go away with the 6% right commission, 3 to the seller's agent and 3 to the buyer's agent, that's one thing. But I would be interested to ask the pool of home sellers that sued the NAR, the National Association of Realtors, if they would lower their prices by 6%. I'm going to give that a pretty slim chance of no. And they most likely were able to sell their prices at what they call inflated prices. And they'd happily, taken the profits.
I guess was it buyers that sued? Must have been buyers that sued.
It was a sellers group, a group of sellers, because the seller pays the 6%. The buyer,
because of that, I see.
Yeah. So the argument, it kind of makes sense on the surface, but I don't know in this particular market where inventory is historically tight, if sellers absent a commission from a real estate agent or 2 real estate agents in this case, I don't know if sellers would reduce their fees or reduce their asking price by 6%.
Yeah, I think that's what's a little bit perplexing here. It's the sellers obviously pay all, right? But the seller also wants the higher price. The buyer is the one that wants the lower price. And so you'd almost think if, like, the lawsuit was around inflating prices. So, like, if I'm a buyer, I don't have any, under prior regulation, I don't pay anything to buy a house, right? And but I want the price to be as low as possible. So if there's incentives to make it higher, if there's incentives to make
We're setting off alarm bells.
Yeah. Timer's off. Got to go. If there's incentives to make the price go up, that potentially isn't as good for buyers. And I think that's kind of part of what this is trying to say. But I guess I'm just perplexed that it was all sellers that were selling.
Well, yeah, how it worked before
suing,
was,
that is.
Yeah, the marketplace was the MLS, the Metro List.
Yeah, multiple listing service.
Listing service. The argument was, if you didn't list there, your house wasn't getting any attention.
I mean, that's kind of true. How many for sale by owner houses even sell? They don't.
Correct. So you needed to get access the pay to play, right? You got to get into the marketplace in the first place.
Get the good stuff.
And the entrance fee is 6% of your home value.
Mm-hmm. Mm-hmm.
And I think that's what sellers are complaining about, because they've had to say, hey, I had $100,000 profit, but I had to pay $30,000
Sure.
of that to both agents.
Sure.
Absent that, I think what we're saying is, absent that, the seller most likely would have sold in this market pretty easily and kept the price high.
Mm-hmm.
Right? I'm not saying, again, it's just came in, so I'm not saying home prices dive in the data. I don't think we're going to see that.
Well, and then the argument on the buyer side is that now if the buyer has to come up with a commission to pay their realtor now, for example, if you're a first-time home buyer and your mortgage broker is calculating your max available debt-to-income ratio, your down payment numbers, and then you can't pay your realtor. Like, how does that work? Do you need regulation to change that, like on the lending side, such that you have a max debt-to-income ratio, but then that commission can be rolled into your 30-year mortgage to pay your buyer's agent?
Correct.
Because I can certainly understand the argument that a buyer that's willing to pay more money could get a better house, or be kind of front running that house.
Yeah. Oh, that's a good point.
Problem.
That's a good point. I didn't think about that, where you come in as a buyer and tell the real estate agent, the selling real estate agent, hey, I'm willing to pay a 4% commission. Why don't you kind of bump me up the top of that list in the bid pool?
Right. Yeah, because it is kind of a, you can negotiate, right? And as the seller, let's say I'm selling a house, I can negotiate what I pay the buyer's agent. I could negotiate what I pay my agent too. And that's just listed, like maybe my house, I'm offering 1.5% commission or whatever, right? And I think the other interesting thing on the regulation is now they can't put that on there. So if I'm offering 1.5% to sell my house to the buyer's agent, right now that's public information. And in theory, you could look that up and go that, steer people away from my house because you're not making a full 3, for example. The regulation says you have to mask that. So I think that the buyer's agent can't find out what they're actually getting paid until the end. I actually think that's good.
Yeah, I think it kind of sets them up in a fiduciary point of view, because
at least tries to get closer to it, right?
Yeah, I could see real estate agents on the buy side migrate their clients towards houses that pay the full 3%, or at least try to influence some of that decision making.
Yeah. Well, and again I will say as a seller, from a seller's point of view, I actually think that so knowing that the seller doesn't need to pay all, I think that does have the potential to increase listings, because it's a significant amount of money to sell a house, like paying the full ride on the commission on both sides, paying excise taxes, all of that stuff. I mean, it can be 8% to move a piece of property, all charged to one person. We certainly have a housing problem in the United States, and I don't think that a change in how realtors are paid will miraculously fix that. But I think that the incentives to sell are, A, I'm in a really low interest rate right now, so I don't want to sell because I don't want to give up my mortgage. And B, I have to pay the full cost of commission. So if that second component goes away, I mean, literally in my mind, it's like, maybe we should buy a bigger house, or maybe we should move to a different neighborhood. I think that.
Yeah, I didn't think about that.
I think that actually could create a more, improve the amount of homes that are listed. Like, I know that builders have an edge in high growth cities, because new construction are the only homes that are hitting the market.
Yeah, and they rarely do.
Well, okay, you're going a different direction.
Yeah.
And you're right about that, because they actually negotiate. They've negotiated forever, and builders pay their realtors much, much less than the stated rate, because it's the amount of deal flow. That's another thing.
Yeah,
but
we're not saying one's causing the other. Sorry, go ahead.
Yeah, no, it's great. No, where I was going with that was just that builders have an edge because more new homes are hitting the market than resale homes.
Correct.
by a percentage. Now, it's not like it's all new homes and no resale homes, but it's because people are locked into these low rates and they don't want to sell. So if there is no rate on a home because it's a new home, that inventory is what's being listed. So builders kind of have an edge on this, because they don't need somebody to sell a house for them to buy their house, to get their house sold. I didn't explain that very well, but anyway, we'll move on. I don't want to say it again. Bad point. Move on. Your point. Over to you, Hal. Thank you. Camera off me.
Yeah, I think that what Chris was trying to say is there's no contingency behind a new home sale, right? The new home builder can just sell the one lot and be done with it without having to wait for another sale to go through or any kind of prior agreements. They could just say, hey, the house is listed for X amount. If you don't want it, you don't buy it. There's 17 other people behind you waiting to buy. But this NAR stuff, at least initially, I don't know if it loosens the market too much. I know we have a really bad inventory problem, but I don't think that suddenly shakes open unless there's this, dual action of interest rates coming down significantly. It would have to. We've talked about that break even point. I think it's 5%. That feels normal, but I don't know.
Yeah, it's going to be incredibly hard to track too, right? Because there's just too many factors. Housing prices are a factor. Interest rates are a factor. This commission thing is a factor, right? I mean, it like I said, it costs a lot of money to sell a house, and so does this then have a hit to the remodel industry? Like, does the remodel industry come down a little bit because now it's easier to sell my house or cheaper to sell my house than it was to keep my house and remodel it? I don't think we're going to be able to predict accurately how this actually plays out, but I do think that it is a more fair marketplace. A lot of factors here, but I do think it's a more fair marketplace if both parties pay to transact.
I think that makes sense. And again, I think we agree that there's a value that real estate professionals provide. These are pretty complex transactions, whether they're involved or not. So, home available by seller or by owner, I could see so many things going wrong there. And you do need someone who is somewhat experienced in it, right? To walk you through the potential bumps in the road with selling a multiple $100,000 piece of property.
It's a big transaction. It's a big asset.
Yeah.
All right. Well, I think that'll probably, maybe this will come up a year or two from today, and we'll see if there's actually any data that says this did that, and then we'll report back. But I think as of now, we'll see. We'll see. All right, moving on. So top companies, our favorite companies, Microsoft and Apple and all these big companies that are at the top of the world right now in terms of size and returns, and they, quite frankly, led the market down in 2022 because they're so big, so they have such an influence on markets, and one could argue that they were overvalued prior to 2022. Now, of course, rearview mirror is always easy to say that. Looking through the windshield, it's hard to know what is overvalued or under, for that matter. And then they all came roaring back in 2023, pulled the market back up. So we thought we would unpack that a little bit because it's not always that the leading companies by size or return are the leading companies for a long, long time. Remember Cisco? Cisco was the leading company in 2001. And Hal, I want to turn it over to you because you dove into this a little bit further in terms of different companies that at one point were the top of the market. So what did you find here in looking into this?
Yeah, our friends at Goldman took the top 10 largest companies and averaged out their performance over 1, 2, 3, and 10-year periods. And they found that the top 10 companies tend to do pretty well. But the unseen part is the competitors of those big dogs end up charging up. And it's as quick as 2 years after this market of dominance that, imagine a Pepsi and there's a Coke comes along, not only matching Pepsi's performance, but exceeding it by an average of 1 to 2% over the next 2, 3, 4, 5 years, because market dominance attracts a lot of attention and competition. And I think that's what makes the stock market or the S&P 500 specifically so special, because yes, you're a market dominator, but as soon as you don't keep up that market dominance, there's someone that had already been creeping up on you, ready to take over, right? What we're seeing right now is with Apple, and the Apple is down pretty significantly relative to the market, right? It was down 4.1% last Thursday, which was yesterday, March 21st, and the S&P was up. And I think the new leader, Microsoft, everyone saw coming, right? And they want more of Microsoft, but let's say 2-3 years down the road, it most likely will be someone else, right? And someone who had been quietly amassing market share away from Microsoft. And if you go through the history of the stock market, going way back to the General Motors dominance days, remember General Motors was the dominant company in the S&P 500?
That's just crazy.
Yeah. It wasn't a tech company. Tech companies are a relatively new thing.
You'd think it would be like Exxon, like an oil company, asset-rich company, company that makes money, but GM.
AT&T.
Crazy. That's also crazy.
Yeah, that was only 1 year, but still AT&T at one time was the biggest company in the S&P. GE, I think that makes sense. Apple. That
makes sense, yeah.
Yeah.
Kind of the recent past.
Apple for a shorter stint, and Microsoft reclaimed its crown, right? Microsoft was one of the biggest companies in the S&P until it wasn't, and now it is again.
Where's Cisco in this? I thought Cisco, maybe Microsoft, anyway. I thought Cisco was the most valuable company in like 2000, but I must have that wrong.
I think they were. Again,
maybe it was a hot minute, and this was like calendar year or something.
Yeah,
like there's a duration on this.
Yeah, and I think the point is things evolve, right? You could see it in your day-to-day life. If you pass, what's the stadium in Seattle? T-Mobile?
T-Mobile Park, yeah.
Safeco before, right? Safeco
before, yeah.
So the naming rights evolve as companies, falter, right? I remember Staples Center, Staples in LA, the office supply store. Well, people are using less paper, so now the unfortunate name of Crypto Arena. So it'll probably be named something else. But I think I use as a metaphor to say company dominance isn't forever. And we always bring this up because the tendency is to chase, right? I want the Microsoft. Well, you wanted Microsoft in the last 2 years. Is it the same for the next 2? I would say yes, but I would look at Microsoft's competitors because history shows that they have a better chance of matching Microsoft's performance, if not exceeding it.
Yeah. And as you say, history has shown that. I think what's most interesting about this is that the leading companies, it's almost like when you become the top company, you're immediately exposing yourself to everybody chipping away at you.
Yeah.
I'm going to get that little tiny bit of your business, and I'm going to do it better because I'm smaller and I'm nimble, and I'm going to innovate on that, and then I'm going to grow. And, yes, maybe that company ultimately gets sold and soaked up into a Microsoft or something. But, I think that's an interesting concept that you are walking out with everything when you become the most popular company, and you're highly watched.
Yeah.
Which is good and bad.
I know NVIDIA has a target on its back. And I think a lot of companies are developing chip production. And one day we might be talking about NVIDIA as number 2.
Mm-hmm.
And
by the way,
go ahead.
Oh,
I was just saying, don't sell NVIDIA. It was just, focus on NVIDIA's competition and see what they're doing because they have a good chance of catching eventually.
I was looking at NVIDIA the other day. I was trying to figure out if these numbers are right. I'm just on Yahoo Finance, which is decent, but sometimes has like wrong information. Yeah. This is showing that they have 2024. It's not. I wonder if this is reporting So for Q1 2024, which they must have some sort of a fiscal year, this is reporting that they have margins at about 50%. Not like gross margins, like profit. It says 22 billion of revenue and 12.25 billion of earnings. That's ridiculous. Is that accurate? Like, is that what it says in Y charts?
Yeah, well, Y charts says it in a different way because we track the price to earnings ratio. So we know what NVIDIA's price did in the last year, right? Gone straight up. But when you track the price to earnings premium that investors are paying for it, it actually drops because the margins improve so greatly. The profits improve so greatly that the premium that you paid in 2022 that seemed so high suddenly got cut in by 25% because their margins improved by that much. Meaning that NVIDIA grew into their premium, essentially. That makes sense.
Yeah, I remember talking about that with you. Yeah.
Yeah, because you pay a higher premium for higher growth companies because there's a stronger chance of them growing into that. Then what looks like an expensive company doesn't look so expensive anymore. I'd argue, even though NVIDIA's price has gone up, it actually fundamentally got cheaper to invest in.
You were talking about another company. You compared NVIDIA to another company when we were doing this the other day. I can't remember that, but you were comparing two. You're comparing NVIDIA's PE ratio to another kind of high-flying PE ratio, and you're like, NVIDIA actually...
Yeah, Supermicro.
Supermicro.
Yeah,
Everybody's
Supermicro.
new favorite company.
Yeah, just so you know, Supermicro is a vendor of NVIDIA, so anytime NVIDIA sells a rack, I'm butchering this up, Supermicro somehow comes in there and establishes like the memory component of it.
Got it.
Yeah, but Supermicro is, I would call NVIDIA on steroids. I don't know if a lot of the listeners know what this company is, but their performance is just out of this world. And they're a big benefactor of NVIDIA's increased business. But we ran the same PE scenario where Supermicro got more and more expensive in terms of price, but they got more and more expensive because the premium paid to invest in Supermicro went up with the price. So the
P was growing faster than the E, basically, right? The price grew faster than the earnings, but from NVIDIA's standpoint, actually the earnings has actually grown faster than the price, even though the price has gone up so much.
Correct. That's what makes it such an amazing company, at least in this very moment. But yeah, it's not so rare that happens. Remember when Amazon was trading at like sky high valuations, but they grew into it, right?
They would show losses, right? But they would have these huge valuations that had negative PE. Yeah. Because they had no P.
Yeah.
Actually, sorry.
No E.
They had no E. They had no E.
Netflix was the same too. And these high-flying companies had, at least the best run ones, have a way to grow into those premiums.
I bring up Supermicro. Well, you brought it up, but I said it's everyone's favorite company because it just got into the S&P. And when a company becomes big enough and it has enough profit, because there's a profit component to any S&P benchmark versus like a Russell benchmark doesn't have that component. That's just kind of how the indexing benchmarking world works. So they just got in the S&P, which is, of course, a size thing as well. And it's like, gosh, I hope that they can maintain their price, because if they can't, I mean, do you get into the S&P and then kicked out immediately because you fall below the size requirement? That would be embarrassing. Yeah. So hopefully they maintain their, at least hold, you know?
Yeah, at least.
All right, let's move on. Quick summary on GDP growth. Some new numbers just came out. The Fed just met. Share with our listeners quickly what the Fed did or did not do in their meeting and what they signaled, and then let's go to GDP growth real quickly.
Yeah, official GDP, just so everyone kind of understands the background. When those numbers come out, it's always a 3-month or quarterly lag. So we'll see GDP from the last quarter. The Atlanta Fed jumps in and speeds up the process, so to speak, by offering what's called GDP Now. And they've actually been pretty good in their forecasting. They don't use lagged data. They have relatively closer insight or real-time insight, hence the name GDP now, on where we're forecasted for. Right now it's at 3%, and we need negatives to have any kind of a recession. And for context, the developed markets like the U.S., they average about 2% growth. So, we're, even including last year, we're well above that 2% barometer, which I think is very healthy for developing or developed country, right? For context, China targets about 7% growth, but they're an emerging country.
Mm-hmm.
So having this kind of growth is absolutely very strong, but I think it goes directly into the interest rate story. If the Fed sees GDP growing so quickly, or more than what they think the economy is capable of, they're most likely going to keep their foot on the brake a lot longer, meaning they'll keep rates higher for a lot longer than what we're most likely comfortable with, right?
And what did the Fed signal when they met this week?
The Fed signaled 0 cuts this round. They are still targeting 3 cuts for the year.
Okay.
But what they did change and didn't really communicate is what the rates for 2025 and 2026 would be.
Oh.
Previously, they settled around 2%. They quietly raised their target forecast to 2.5% over the next 3 years. So we were looking at a floor of 2% flat, which in industry jargon it's called the neutral rate, meaning if I set a rate at a certain level, I would expect a certain level of inflation and a certain level of economic activity. Like more than that, I'm slowing the economy down. Less than that, I'm speeding the economy up. And that's what they were targeting as their neutral rate. It looks like they increased their neutral rate, meaning people have the capacity to spend more than what the Fed has expected so far.
Yeah, interesting. Okay. Interesting. Yeah. No other thoughts on that. I think that was a really good synopsis. Let's shift over to AI on earnings calls. We have the second highest number of S&P 500 companies citing AI on earnings calls in the last 10 years. And what we wanted to look at is, why in the world is everybody saying AI? Are they saying this because they're implementing it, or saying this because that's kind of what the market wants to hear and maybe the stock price goes up? What we found was kind of the latter. So there's a bunch of information here. This is from FactSet. FactSet does great deep dive articles. The highest number of AI citations on Q4 2023 earnings calls, NVIDIA said it 114 times, Salesforce 93 times. I'm just going to list out a handful here. Alphabet 79, Microsoft 72, Meta 67, HP 63. How's their stock doing? Broadcom 54, and Aristanet 53. The only one I didn't mention here, because I skipped over it because I thought no one would know, the company, Cadence Design Systems. I don't even know I don't even know who they are. It's like a big company that I've just never heard of.
Actually, yeah, they're in our full disclosure. We run a stock model. The Cadence Design System is in that particular stock model. They design, I guess, the blueprint for chipsets.
Well, they're talking about AI 84 times on their latest call. Did their stock go up because of it?
They're a pretty big company, relatively speaking. They have a $80 billion market cap.
Interesting.
So, but yeah, they are a benefactor of AI because as you're designing new GPUs, Cadence Design System is the company apparently that does some of the design work behind it.
Interesting. So most of these, if you can guess, most of these are coming from technology companies, but the next two in line you might find interesting. Industrials is the second highest was going to say criminal. The second highest criminal that's saying this. The second highest type of company that is saying this so many times on their earnings calls, industrials. And the third is financials. So financial industry, banks, insurance companies, that kind of thing. They're saying this a lot. Industrials, a little more. And then, of course, tech, even more.
I think financials make sense, at least from what I'm hearing about it, right? Because credit analysis, things like that, looking for potential weaknesses in the banking system specific to the bank. I could see a use case for AI.
I don't want to be totally crass with it, but banks have a ton of employees. I see where you're going with this. I think that AI could definitely shift around that industry and ultimately make banks more profitable, because human capital is the most expensive thing for most companies. So I don't know. I think that could be a really good, AI could be a good benefit, or banks could be a good benefactor of AI because of that.
Yeah.
Industrials, not so sure where that goes, but
I was trying to look what's in industrials. You think defense companies? I would again assume. I'm being super ignorant about it though, but I would assume anyone who builds F-35s, fighter jets, would use a component of AI to help with their navigation or flight patterns, things like that. What metal balances would, absorb the most heat or the least amount of heat, right? I'm sure this is all something that's been figured out chemically by actual people, but I think AI can be deployed to find new mixes, new alloys, things like that.
Definitely. Yeah, and you can have one person running that, and it's like having a whole team in a lab, doing it so much faster. I mean, it's cool. I think it's got a lot of use cases there. That's interesting. That I'll have to think about that more. How industrials are.
Yeah, and if you're in the defense or industrial industry, like we'd love to hear what.
Yeah, tell us how you're
kicking the tires on. Because
totally. Yeah. Okay, let's go over. I want to shift it over to you. So the findings, sort of the punchline, I suppose. So when a company says AI, what does their stock price generally do relative to these companies that aren't saying it as much? I think what you're about to say will give us clues why CEOs are saying this so many times on their earnings call. And I would like to announce that Consilio Wealth has a AI presence, and that's why our stock is going to go up here, because this is our earnings call. See, so
what's a ticker?
Yeah, we're going to partner.
CWA.
We're partnering with NVIDIA, and together our stock is going to go up a lot.
What's the ticker once we go public, right?
CWA.
Okay. We should check if it's used. I don't know. We should check if it's taken.
With that again.
Yeah. But to answer, CWA is available, actually. To answer Chris's question about what the stock performance is. And I'm probably going to be what came first, chicken or the egg here. But if you're a company citing AI, you were up on average 28.6% versus a company who didn't mention AI, you're up 17%. Now comes the question, that's nearly a double performance, right? Double the rate of performance. Are you doing that well because you are doing a tried and true AI approach versus a company who, has no right mentioning AI, at least in this stage? I would imagine someone like maybe a Domino's would, but someone like a Papa John's or a Darden Restaurants who owns Olive Garden, like where is AI really saving? In part of the big AI explanation is NVIDIA, right? They mentioned over 100 times on their earnings call, and they are making money hand over fist. So that's what I meant by the chicken or the egg is you know what I mean? Like, are they benefiting business infrastructure build out, and the ones who aren't really have no ties to AI at the very moment?
So food businesses would fall in consumer staples, right?
Yeah.
Or is it consumer discretionary?
Depends on. Oh my
depends
gosh!
On
it depends on the type of
All right. Well,
company.
either way,
Yeah.
there's 8 consumer staples. I mean, I think it would be staples because discretionary, like Amazon actually falls in consumer discretionary, for example. You don't
So does
have to buy
Tesla.
stuff
Yeah.
on Amazon.
Yep. Yep.
Right, right. But you kind of have to buy food, at least at some point. Anyway, so 8 companies on this list in consumer staples. Wonder who they are. And then 20 in consumer discretionary. We know that one of those is Amazon, but yeah, it's interesting.
But yeah, just
Well,
because you mentioned AI, I don't think the market's really rewarding that. Just for the buzzword, right? At least not yet. Remember when crypto was at its height in this the New York Long Island iced tea company changed their name to Blockchain Iced Tea, and they were up 200%. Later, the founders were, guilty of fraud. But I think once it hits that, it might be okay. Things have gone a little too far with this buzzword, market pumping mood here.
yeah.
But I don't think we're there. What do you think?
I mean, I hope you're right. I think that there's still a lot of benefactors that will. So, if, for example, let's pick on Microsoft, who seems to be the leader in this space right now. They've gone up a lot, right? So, if that company creates products that ultimately go get used by other companies that make other companies more efficient in whatever way you want to measure that, then that starts to trickle down to those other companies, right? So it starts at kind of the top, I guess, pun intended now. But then as adoption happens, right? Because I don't know how much adoption Microsoft has on all their investment yet. Just can't speak to that. I don't know if they're reporting that. Don't know. But as those products actually come online, can it save time? Can it save money for so many other companies? I mean, just think of all the small software companies that could potentially write code faster with an AI-powered GitHub owned by Microsoft, right? So, like, if that works, you've got small companies worth more because they're growing revenues at, let's say, the same rate, but doing it at a cheaper cost. Now that starts to benefit everything. So I think that relates to your point that says, maybe we're not at the top, peak excitement yet.
Yeah.
But I don't think that we've totally seen this get through the markets yet and get into all companies in the full way. I think we just have a couple of players that have been rewarded at this point, and it'll take time to see who at the top is really, creating value. I don't think we know that yet. And then how does that trickle down to other companies?
Yeah.
That's my 2 cents. Could be wrong. Could be right. All right. Last thing. Let's shift over to industry analysts project a 7% increase in the S&P between now and the next 12 months. This article just came out, so this is pretty much recent. It was posted yesterday, actually. And I don't know if anybody's ever noticed this, but analysts always project stocks go up. You notice that? It's like, what's the price target on Microsoft? Higher than it is now.
Yeah.
What's the price target on any stock? Higher than it is now, right? It's always that way. Rarely do predictions say it's going to be lower in the future. And so this is kind of our joke internally is like, don't follow the price targets, don't follow the predictions, because they just always assume that, things go up. And by the way, things do generally go up. So that's I suppose an easy prediction to make. But I always love when companies come out and they have such a hard and fast number, like 7%. That's the number. That's what it's going to do. What? Based on what? So they're saying that things like healthcare and real estate, which had not great years last year, will have better years this year. Those are going to be the leading sectors this year. That's what they're saying as of now. Quick check on how those areas are doing as of right now. Not awesome. So the healthcare industry right now, actually, let me start with real estate. Real estate is the bottom performing sector in the S&P. It's down about 2.5% this year. Healthcare is somewhere in the middle. It's up about 6.7. The S&P is up about 7.6. So, slightly under the average. So, things can turn around, right? Rates could come down, for example. Maybe that benefits real estate and healthcare. And then the bottom, according to this prediction, is going to be materials and industrials. Materials currently up 6.1%. That is a couple up from the bottom. And industrials up 7.2%, basically in line with the S&P itself. So, okay. Could be some interesting stuff that plays out here. Our question really was, how often are these things right and how often are these things wrong? So how accurate have industry analysts been in predicting the future value of the S&P? And the answer is, historically, analysts have overestimated, what a shocker, they've overestimated the closing price of the index by anywhere from 3 to 8% on average over the last 20 years. Over the last 5 years, they've overestimated by 4.6. The last 10 years, overestimated by 2.9. Over the last 15 years, overestimated by 5.4. And over the last 20 years, overestimated by 8.3. Let me pause there. What's your take on this, Hal? Or take us a little further.
Yeah, if I were going to go back to the expected sector performance going forward, those are definitely buy low candidates. I wouldn't say rush to overweight them if you do have enough real estate and enough healthcare. Healthcare could be one of two things: biotech, which is hyper aggressive, and they're tried and true traditional insurance companies, hospitals, and healthcare companies. I think buy low makes sense, though, right? I think what we're trying to combat recently is stop trying to chase the higher performers, right? Because they're up in the 6th floor. Some of these are in the basement, right? Mm-hmm. And if something does happen, that's one scenario where you fall from the 6th floor, you're going to hurt yourself. You fall from the basement, you're not going to hurt yourself. But the forward-looking point of view is real estate has a lot of negativity baked in. I don't know if anyone's heard about this impending commercial real estate crash that seems to be like the slowest moving train in the world. I have yet to see the apocalypse. Yes, commercial buildings are getting marked down, but I don't see it as real estate shocking yet. Mm-hmm. At least I don't know. We were looking at this visual capitalist, the number of people working from home, still a fraction of the number of people in the office. Cities and states have super high incentives of keeping the Microsofts in Seattle, right? Keeping the Amazons in Seattle, physical presence, spending money during their lunch period, going to happy hour after work, right? There's huge incentives to keep those buildings fully occupied. And I'm pretty sure Microsoft and Amazon have benefited from a certain level of subsidies from the greater Seattle area. And they in turn want to get their back scratched. And that's just the commercial side. Look for apartments, multifamily homes, single family homes, hospitals, healthcare facilities like memory care. Those are all real estate. Those are all very favorable demographics. Server space is a real estate, right?
Yeah. Data centers.
What's the
distribution centers?
Cell phone towers, real estate. Mm-hmm. So there's a lot of components to real estate to really, really like. And if you're concerned about office space, yeah, that's probably a real concern, but I don't think it's enough to drag the entire sector down.
This is also what's interesting here. So, we talked about how, saying like real estate and healthcare are expected to be the largest increase over the next 12 months, according to this article. This is not, anyway, it's just this article. But then when you go down to the difference, go ahead.
Sorry, let me break down. Maybe that's what you asked me, and I completely went over your question. FactSet does a good job of consolidating analyst opinion. So, what the forecast that Chris cited is not a FactSet forecast per se. It's like a consolidation
bunch
of
them.
All. Yes.
Good call out. Yeah, good call out.
So what they're citing is the analysts in those particular industries are probably the most bullish of all the 11 sectors in the S&P.
So what's interesting about this, so if I take it a step further, there's a chart down here with the top 10 difference between the target price and the closing price. So the top 10 that are in theory, way undervalued. And then the top 10 that are actually overvalued. And these aren't the companies that are in those sectors. So like according to this, not a recommendation, don't go out and buy the stock. Or if you do, that's not because we said it here. The number one most
don't hate us.
Yeah, it's not our game. We're just reading an article. First Solar, apparently that is 50% away from its price target right now. Closing price of about $151, price target of $225. Caesars Entertainment, 48% away. Boeing, okay, 40% away. Warner Brothers Discovery, 37% away. Biogen. Anyway, point is, these companies they're not in real estate. I mean, even Caesars Entertainment, that can't be, it's just all, it's all casinos. I don't know if their real estate portfolio is sitting in there. And then the worst, so these companies are anywhere from 8 to 20% over. You've got companies like Steel Dynamics, Fastenal Company, WestRock Company, Robert Half, Airbnb, PACCAR, Marathon Petroleum, Expeditors, Caterpillar, T. Rowe Price. Okay, those companies aren't anywhere near the bottom. So I'm a little confused at, again, FactSet's aggregating this. So
yeah,
there's a little bit of a lot of numbers all in one article. But I would assume that if healthcare is supposed to lead the way, I would see a bunch of healthcare companies in the
implied
undervalued section.
Yeah.
And I mean, I see maybe one or two. I don't know what some of these, Biogen. I don't know what some of these companies are, but.
Yeah, that's the thing with FactSet, which I do like. It doesn't, since it pulls all these, let's say Boeing has 30 analysts following it. If 10 of them downgrade Boeing, it's still going to average relatively high in terms of prices.
Yeah.
So going through that list, though, that's why I chuckled a little bit. First Solar, Insulet, Boeing, Warner Brothers, Biogen. If you Google those names, you're going to see a lot of negative headlines. Boeing for a lot of obvious reasons. So that there's a bit of a lag in terms of bringing the price targets down from the analysts, because let's say widely followed company like First Solar, it's going to take a lot of downgrades from the group of analysts. So the price target stays relatively stuck for a while unless all the analysts come on board. Part of it too, what I've seen with regional banks last year is they kept the price targets but lowered their buy ratings down to hold. So you have this really high price target and this really lukewarm, investment, recommendation. What that means is there is a lot of implied risk, right? Boeing right now, you don't know what the next plane issue is going to be, if there is going to be one. So we call that trying to catch a falling knife. But if you do, you're successful, you're going to see a really nice turnaround. It happened with Meta in 22. It happened with Netflix 22. NVIDIA in 22. It happened with airlines that stayed afloat in 2020. Right? So are you buying these things in the muck? Meaning when there's blood in the streets, you're buying? There you go. Go buy Boeing. But I'm not saying go buy Boeing. Let's edit that out. But I'm saying if you are, and you're right, you're going to benefit from it. But you're buying something that carries a lot of risks that are unknown. That's really the heart of value investing. And that's how you read the price targets, especially with companies that have lots of analysts following them. I wouldn't go look, because these are all public. I wouldn't go look and say, hey, who has the highest price target? Because I can find you a company that has 100% upside. You don't want to invest in those. Yeah, you don't want to invest in those.
And that's the thing, is that the price targets can just come down. And that's the price target is almost always above the current stock price.
Almost always,
but then it will come down or it will go up depending on where the stock price is. Is to kind of keep a relative barrier, right? And so that's why it's a very challenging thing to trade on. Correct. Even though it's right next to, whenever you look up a stock, you're like, Microsoft's at this price. Price target's that price. Maybe I'll buy. I'll make $25 a share. It's like, well, it's just
exactly.
It's not that easy.
Yeah, there were price targets for Tesla like $500 a share.
Yeah, I think even 1,000. You'll see Bitcoin estimates at 100,000 and 1 million and all these things. Sure, I can put a price target, but
Yes.
it doesn't, it's more of a momentum.
Correct. Yeah.
That's trying to be expressed.
I think what we're saying is know how the structure is kind of set up for that, and take any of those price targets with a big grain of salt.
Yep. So here's the last grain of salt. On March 20th, this price prediction says that 1 year from today, the S&P will close at 5,589.06.
7% up from here.
We'll see if they're right. All right.
That would put it at 15% year, which is one of the better years, but nothing so crazy.
And it would only put us about 15% above the high of 2 years ago, which is about 7% a year, which is pretty average, right? That's actually normal. So I know we talked on our prior podcast that the market being the S&P, but it just went above its high 2 years ago. And that was the seventh time in history that it took 2 years to recover. And I think a lot of us have forgotten that the market's actually been underwater for a while, right? It's been going up since Halloween. It's had these ups and downs, right? But it just recently, about 2 months ago, went above its prior high 2 years ago. Good stuff. All right.
Great.
Thanks everyone for joining today. That's all the time we have. We will catch you again in 2 weeks.
All right. See you soon.